People tend to think of the stock market a little bit like a casino. Like you can just go in, make your bet, stand back, cross your fingers, and hope you hit the jackpot. Well, not really the ideal way to approach investing. Investing is a lot less like a game of roulette and more like a game of chess. You don't trust in dumb luck. You follow the rules and you make strategic moves that will help you come out on top. Of course, the trick is you need to know the rules. Just like any game, if you're gonna win the game, you've got to know the rules. Hey, I'm Lorianne. I'm co-founder of Dow Janes and a money coach. And as someone who lost $15,000 on my very first investment, but has since learned the rules of the game and made way more than that through my investing, I've learned how to invest the hard way. So today I'm giving you 10 rules for investing so that you can make passive income with confidence. I want you to keep track of how many of these rules you're following and leave a comment for me down below. Let me know how many of these are you already following. Okay, rule number 1, don't invest before you're ready. Make sure you are financially prepared to invest. You don't want to start before you're ready because that can end up leading you to actually losing money in the stock market. Here's our 5-step roadmap on how we recommend going about making sure you have the financial foundation in place that you need before you start investing. Step 1, spend less money than you make every month. Step 2, use that remaining savings at the end of the month to pay off any high interest rate debt that you have. I'll talk more about this later. Step number 3, build up an emergency fund. Step number 4, now you can save for retirement and start to invest those savings. If you want to get on track to invest, check out our 5-step to building wealth video, which I'm going to link to down below. Now, the reason we recommend following this roadmap before you start investing is we want to make sure that you have an emergency fund in place. So, if you ever have an unexpected situation happen where you need access to your money, you've got money sitting in cash that's available to you and you don't have to go pull your money out of the stock market to take care of whatever has come up. This is really important because investing in the stock market, by nature, there are going to be fluctuations in the value of your investment. Honestly, every second, the value goes up and down. Over the course of a day, a week, a month, a year, your investment could be down at any period of time. It could be because you're investing with a long-term strategy. This is okay. This doesn't mean you've lost money. It's a natural fluctuation of the stock market. But if you're forced to pull your money out while it's down, that's how you lose money investing. So we want to make sure that you have a solid financial foundation so that you have a very high probability of having profitable, successful investments once you get started. Okay, rule number 2, think of investing as a long-term strategy. Investing is not meant to be a get-rich-quick scheme. Okay, wealth loves time. You don't invest your money and collect your profits the next day. When it comes to investing, the best strategy is buy and hold, and to let your money sit for usually at least 5 years. If you don't think you'll be able to leave that money in for 5 years, you shouldn't be investing it. Rule number 3, don't invest in what you don't understand. This is the mistake I made, and that's how I lost my first $15,000. Financial literacy is crucial to having financial success. And there are so many investment options out there. You need to do your research and gain the literacy to actually make sure you understand what it is that you're investing in and you think it's a valuable thing that is going to continue to appreciate in value. If, for example, you don't understand anything about Bitcoin or blockchain technology and you don't know why it's valuable or why it would keep appreciating, it probably doesn't make sense to invest in that type of asset if it's not something you understand. Rule number 4, aim to double your portfolio every 10 years. This isn't a perfect rule, of course it's going to depend on your situation, but it's a great goal to aim for. Rule number 5, don't gamble, invest. The safe bet in investing is to invest in the stock market in a highly diversified way. This has the longest track record of stable returns and of always appreciating on average over the long term. If you're going to invest in single stocks, meaning you're just choosing one company and you're putting all your eggs in that basket, I want you to think of that a little more like gambling and a little less like investing. and never ever be willing to invest more than you can afford to lose. Rule number 6, diversify your investments. So just how I was talking about how I don't really recommend single stock investing, this is because you're putting all of your eggs in one basket. And you want to make sure that if your investments lose money, you don't lose all of your money. And when you invest in just one thing, you're more at risk of that happening. So we recommend diversifying your investments. This ensures that your financial situation is not completely dependent on any one given company. Instead, you can ride up and down any fluctuations in the market and experience the appreciation of the growing economy over the long term. Speaking of diversifying, here's a quick trick for figuring out how much of your portfolio you should invest in stocks. This is rule number 7. Subtract your age from 100. The resulting number is the percentage of your portfolio that you should likely invest in stocks. Stocks are considered a higher risk investment, which means they have more volatility and they can be high reward, but they also could have less of a reward. And in order to make it most likely that you will have the best returns, you need to give them a lot of time to mature. As you get older and closer to retirement, you have less time for your investments to grow, and you have less time for your investments to recover if they do poorly. So it's best to start diversifying your portfolio and investing in lower risk investments like bonds in addition to your stocks. Rule number 8, don't check your investments too often. Look, remember the best approach is a buy and hold approach. We want to be investing for the long term. And the stock market, it's a roller coaster. It literally goes up and down all the time. And if you check it too often, it can start messing with your head, okay? Like I said at the beginning, it's a long-term strategy. And historically, the stock market has always recovered. So make your investments, set them and forget them, and leave them alone. Rule number 9, buy when people are selling. When the market drops, people start selling, and often they start panicking. You never want to do this if you can help it. You don't want to be selling at the bottom of the market when what you have bought has gone down in value. In fact, counterintuitively, when the market is down, is often the best time to buy. Things are on a discount. And if you can afford to wait long enough and you're investing for the long term, historically, the stock market has always recovered and continued to rise. So buy your ETFs when they are comparatively cheap, and you'll thank yourself when the market recovers. Rule number 10, minimize fees. When you follow these rules, self-managing your investment portfolio is easy. So you don't need to pay a financial advisor. In fact, if you want to uplevel your investing game, you can check out our free masterclass, Think Like an Investor, to learn the secret of successful investors. But if you do currently use a financial advisor or a robo-advisor, you'll want to look at what you're paying them in fees. Make sure you're not paying more than 0.3% in fees, because these fees really add up and eat into your investment returns to the tunes of tens and hundreds of thousands of dollars over the course of your investments. All right, tally up your score. Let me know in the comments below how many of these rules are you currently following with your investment strategy. And if you like this video, make sure you click the bell to be notified of future videos, give us a thumbs up, and subscribe.